Welcome, everybody. Cal Ewing here. Thanks for coming into this Deals of the Week webinar. This is my first rendition of what I hope to be a somewhat regular webinar for all of you that are interested in investing in mortgage notes. The whole goal here is to just give everyone that's interested in attending these webinars just a feel for what note deals look like, how I analyze a note deal, a good one versus a bad one, and just to draw up interest and help maybe educate you as a potential note investor who's just getting into analyzing and investing in mortgage notes. So this is perfect opportunity for anyone that's new to the mortgage note investing space. Also, anyone that might be interested in jumping on board with us at 49th Parallel Properties in doing note deals with us as a funding partner. So whether you're looking to buy notes yourself or do deals with us, or just curious about what the whole note investing thing's all about, I welcome you here tonight, and hopefully in future renditions and episodes of Note Deals of the Week. All right, so basically how this is going to work is after I introduce myself, I'm going to go through about 2 notes right now. You know, each time we do this, it might be 2 or 3, maybe 1, depending on how in depth we get. Today, I've got 2 lined up. And sometimes I'm going to analyze duds. So just showing you what a bad deal might look like versus a good one. Might analyze some notes that I've already purchased that are in my portfolio, or deals that I've got accepted bids on that I'm now doing my due diligence on and looking to close. So we're going to mix it up here and there. So if you like this episode or this webinar, this version of this webinar, I encourage you, and I'll definitely reach out to you, everyone that's in attendance, for future opportunities to get on these webinars again. So for those of you that are new to me, my name is Cal Ewing, and I've been investing in real estate and mortgage notes since, 2009. Around that time when I was in university, I was actually in university studying to be a geologist and was learning real estate from Rich Dad Poor Dad, actually, is where I got my start. And I got the real estate bug like so many people do. And that really affected the whole path of my career. I now invest in real estate as well as underwrite for a private lending company here in Calgary, Alberta, Canada. So my day job is an underwriter. Kind of my other business is buying notes, mortgage notes. And so I've gotten really into that in the last few years. I used to buy a lot of houses, wholesale a lot of houses, do fix and flips and that kind of thing. But more lately, I've gotten really passionate about buying mortgage notes, mainly for cash flow. So my whole goal for my own business is to acquire cash flowing mortgage notes and just acquire more and more streams of income so that every month I get another check in the mail or deposited into my account from a borrower whose note I own, and they're paying their monthly loan payment to me. I'm the bank essentially, and I get checks coming in, every month. And my goal is to increase my cash flow so that maybe one day I can either, take a year off and travel or do whatever I want, pursue other interests, but I won't have to worry because income's coming in from the notes that I own month in, month out. Okay, and so if you're interested in investing in mortgage notes or just really keen on growing your own income or growing your retirement savings so that you can retire better or retire sooner with more money saved up, or just looking like I am to grow, opportunities to get more passive income, then mortgage note investing is a great place to look. And as I mentioned, I'm a Canadian. I live in Calgary, Canada still, but I've been investing in U.S. real estate solely. The only Canadian property I've ever bought was the house I'm sitting in right now. Otherwise, I've done, over 100 real estate deals, all kinds of different types. And so it doesn't matter if you live in the U.S., great, but you don't have to necessarily be a U.S. citizen. If you're watching this from somewhere else, maybe Canada like I am, I'm proof to show that you can buy mortgage notes from really wherever you are, okay? So without further ado, I am going to share my screen here, and then we're going to jump into the 2 note deals I'm going to analyze this week. Okay, so this week we are going to look at 2 performing notes. One of them is a recent acquisition that I just bought and put into my portfolio just in the last month in Detroit. And then another one is one that I am looking at right now. I've got a bid accepted, and I'm hoping to purchase that one as well. So let's go. And if you have any questions, unfortunately, I think I've got the chat thing turned off here. But feel free to reach out to me, write your questions down, and you can email them to me after or post them under this video. And I'm happy to answer any questions you've got, okay? Or we can set up a call and talk. All right, so let's get into it. Okay, so yeah, this is a property in a suburb of Detroit, Michigan, Inkster Road. And the cool thing about note investing is what you're really looking at is the numbers, the mortgage numbers. So the interest rate, the principal balance, the loan term, how long that the borrower's been paying, how many years that they're in to the loan term, and then the performance history, principal and interest payments. So you're really looking at the loan details that you're buying. So we're buying a mortgage. We're not actually buying a house here. And so you want to look at the details of the actual mortgage loan or the note. And then you also want to look at the collateral, which is the house or the property that loan is secured to. Okay. So when I bought this note, I don't actually own this property. I own the loan, the mortgage, and then the borrower now makes payments to me because I'm the bank now. So I'm like the Wells Fargo or Bank of America, or if you're in Canada, like the TD Bank, okay? And so when I bought this loan, the borrower is now owing me monthly payments, okay? And this is what you call a performing note, all right? So what that means is the borrower, typically the borrower, if it's a performing loan, the borrower has been paying for at least the last 6 months to a year. In this case, this borrower has been paying for quite a few years without missing any payments. They've been pretty good on time. And when I bought the note, they were current. Okay, so it means that they weren't behind on any payments. They were performing every month, meeting their obligations. Okay, so here's the numbers. What this note looked like. So the value of this property, I know it doesn't look great, but in note investing, you don't really care. You don't necessarily need the prettiest properties. Okay. So the value of this property is $140,000. And how I established that is I actually got a local real estate agent to go and do a broker price opinion, or a BPO, where they study recent sales that are similar in location and size and age and condition, and then active listings as well on the market. And then they established a value of 140 for this property in its as-is condition. Okay. Now, the balance owing on this loan, so this is the amount that the borrower owes on their mortgage, was $36,300 when I bought the note, which is about a month ago. So they're about the same. And I was able to buy this note from the note seller, who was a private investor. They owned an investment fund, and they were selling off some of their assets. So I bought this from that fund for $29,500. Okay. And I actually bought this one with the help of a private investor from here in Canada. Actually, he came on as my funding partner. So I can explain a little bit more about how that works. But with the funding partner, we were able to purchase this note for $29,500 US. And the interest rate that the borrower is currently paying on their loan is 10%. Okay. So that means that when the borrower bought this property, they signed a mortgage with the rate of 10%, and they've been paying it ever since it looks like April 2012. Okay, so they've been paying on this mortgage for over 10 years now, and it was a 30-year mortgage. So that means that the interest rate is set and fixed for 30 years, and that's the amortization rate. So they have 30 years to pay off this mortgage. Okay, so when I stepped in and bought this note, the borrower owes me $36,000, and they have until March of 2042 to get it paid off, right? And they're paying on an amortization schedule, just like anyone else. When you buy a house and you get a mortgage, right? Usually the first few months of your mortgage payment, you're going to be paying mostly interest, right? For actually the first couple of years, most of your payment is interest and very little is principal pay down. And then as you get down over the years to paying off your mortgage, whether it's a 30 or 20-year mortgage, the last few years, you're paying mostly principal balance and very little interest, okay? So being 10 years or so in, 11 years in. It's kind of a mix as far as how much principal and interest is being paid, but still more interest is being paid than principal pay down. Okay, so the monthly payment on this note is $362 a month. Okay, so that's principal and interest. Okay, and like I said, it's a 30-year loan. So let's see, first of all, what does this look like from a cash flow perspective? Because when I buy a performing loan, my whole goal is to create a passive income stream for myself. Okay, so let's look at that first. Okay, so as I said, we bought this note. We bought the loan or the mortgage, not the house, for $29,500. Okay, so making $362 a month. So as of last month, this borrower, the person that owns this house and has the mortgage, is now sending me or my company a check for $362 every month. And we do this through a loan servicing company. So they actually handle all the day-to-day and reporting of everything. They keep track of how much interest, how much principal, any late payments that need to be charged. They do the annual reporting. So they basically do all the work that I don't really want to do because I don't care. I'm not I'm not an accountant. I'm not a bookkeeper. I don't like doing that kind of work. And so it's great having a loan servicing company collect all the payments, deal with the borrower, and then just send me the reporting and of course the money every month. Okay. So annual income. So if you take that $362 times that by 12 months, the annual income on this note is $4,344. Okay. So is that a good investment or not? Is that a good yield or a good cash on cash return? Well, if you take that annual income from this note divided by the purchase price or the amount of cash put in to the deal, it turns out to be a 15% yield. Okay. So that's pretty great. That's exactly my target. Whenever I buy a note, I'm looking, especially if I'm working with a funding partner who puts up the money to purchase the note, we have to divvy up this cash flow. And so I'm looking for notes that yield about 14, 15 or more return. Okay. And so I guess I will stop and talk about that now. So a lot of the deals, if I don't have the cash myself available because it's in other deals, I work a lot with private investors. So people that have IRA retirement savings accounts that they want to invest their funds into to get a nice return. Just people that have investment accounts or money that's sitting on the sidelines that they'd like to earn a nice return. They actually partner with me as a funding partner, and they come on and we have a loan agreement. They basically lend the money to my company to purchase the loan, purchase this note, and then in turn I pay upwards of 8, sometimes 10% return to use their money to buy the loan. So, and that's what's happening in this case is out of that monthly principal and interest payment, I'm paying my private investor 8% return. And then the rest of the money left over would be my company's profit. Okay. All right. So that's if it's performing. All right. But the great thing about note investing is we've got some other exit strategies in place to make sure that we don't lose money on the deal. And one of those is our ability to foreclose on the borrower, just like any bank has that right and ability. We can foreclose on the borrower if they were to stop making their payments. Okay. And so I always run my numbers before I buy any note. I want to make sure that I'm at least going to get my investors' money back or my money back. And hopefully a little bit of profit as well if we had to foreclose on the borrower should they stop making their payments. And you know that happens, right? People pass away, people lose their jobs, people get divorced or get sick or whatever it might be, right? So that's always something that they're, excuse me, it's always a possibility. And so we want to make sure we're prepared for it. Because if we were to buy the note wrong and then had to foreclose, we never want to lose money in that case, okay? So as I mentioned, I got a broker price opinion that said that this property is valued at $140,000 in its current as is condition. And so whenever I analyze a foreclosure, I assume that whoever's buying that property, when we go and sell it at the foreclosure auction, they're going to want to buy it at a discount, right? Most investors that go to the auctions, they don't want to pay full price for a property. And maybe in some markets they would, or they get in a bidding war. But I want to assume that my buyer, whoever bids on the property, is going to pay, 70 to 80% of the actual value. They want to buy it, get a deal, right? So in this case, I estimate pretty conservative, actually. In this case, 112,000. Okay, is what they would bid. Okay, but because it doesn't really matter in this case, because the property is worth so much more than the balance of the loan, right? This is how much this borrower owes on this mortgage note, on their mortgage. What it sells for doesn't really matter to me, because I know that there's no way that this thing, a house worth 140,000, there's no way it's going to sell at the auction for less than 36,000, or even, let's take it a step further, than the 29.5 that we invested into this deal. Like, it would be crazy if the property sold for that low, right? So all I care about here is that I know that, with 99% certainty, that if we were to take this to the foreclosure auction, someone's going to bid well above this principal balance. Okay. And that's the only amount that I'm actually entitled to when I foreclose on this note. Because I am the lender, not the property owner, I'm only able to recoup the 36,000 or whatever the amount that the borrower owes on that mortgage loan. Okay. Now, there could be some late penalties and things I would charge as well, back payments. So, if they were to stop paying, I probably would be able to recoup more. But just in general, I know that whatever I'm going to be owed on this mortgage, we're going to sell for way more. And so I'm going to get the full amount that's owed to me as the note holder. Okay. So in this case, 36,000. And then anything over and above would be claimable by the property owner / borrower. Okay. So in this case, in a foreclosure, we'd sell it for 36,000. And since I paid, or my investor paid 29.5, there's a profit of about 6,800. So not a huge profit here, but it's not a really big investment either. We paid just under 30,000 for it, right? So what I care about here is I'm not buying this to foreclose. That's not my goal. My goal is the cash flow, right? But I know I can sleep at night knowing that, there's at least 6,800 that if we did have to foreclose, we're good, right? We're not going to lose money. Okay. So that's great. Now, the other thing, I guess, before we switch slides here, sometimes if the note is the note balance, the balance that the borrower owes is higher, and it's maybe more than the value of the property or more than the investor would pay. So sometimes no one's going to bid on that property because we would start the bidding, because as the note holder, I can start the bidding at whatever I want. We would want to start it at the highest amount possible. So there could be a chance that the asking price, the starting bid, is too much and no one wants to bid on it. And in that case, if no one bids on the property, then me being the note holder, I would then own the property. It's called an REO. As the lender, I now take ownership or take back that property, and now the property's mine. Okay. But because there's such a huge spread between the property value and the principal balance, if we were to foreclose, that thing's going to get sold at the auction for well above what's owed to me as the note holder. All right. So the other option besides foreclosure that we would probably want to take is to negotiate what's called a deed in lieu of foreclosure. Okay. And so what that is, it's basically going and saying, hello, Mr. and Mrs. Borrower. Obviously, you're not making your payments on your mortgage. We see that there's a problem here. We could either take the foreclosure route, which is going to be not very good for your credit. It's going to stay on your credit score for 7 years. It may impact your ability to get a new mortgage. It may impact your ability to even rent a property, maybe even get a cell phone, because some cell phone companies pull your credit, right? So it's going to be very bad for your credit if we have to go and foreclose on you. So, Mr. and Mrs. Borrower, what if we can negotiate where we pay you some money, maybe $3,000, $5,000, just enough to pay for moving costs or maybe pay for a deposit on a place for them to rent. And instead, they just deed me as the note holder, as their lender, they deed me the property. And it's called a deed in lieu of foreclosure. So you're allowed to deed the property back to your lender instead of going through the whole foreclosure process, okay? And that's also known as a cash for keys. So basically we say, look, we'll pay you some cash if you give us the keys and the deed to the property. You go on your way. We won't foreclose. It won't impact your credit anymore. Wipe your hands clean of this situation and move on, and we get the property, okay? So that's the other option. And so in this case, as I said, if it's a $140,000 home, and let's say that we negotiate about $5,000. So we agree to pay the borrower $5,000 to move out. Okay, well, now I own the property. I get the deed to the property, right? I've given them $5,000. They've moved out. They've deeded the property over to me. And now I'm the owner. Okay, so what do? Well, I have lots of options here. I now own this property. I only invested $29,500 to get this property. I've given $5,000 to the borrower to move out. So, now I'm around $35,000 in, but I own a property worth $140,000. So I could keep it as a rental. I could remodel it and sell it for well above $140,000, right? Or I could just sell it as is. I could call up a real estate agent and say, look, I own this property. I don't want to fix it up. Can you just list it on the MLS and sell it for as high as you can? Okay, so that's what this number looks like, or this breakdown is, okay? So let's say I want a quick sale. So I might call my realtor and just say, start the bidding, start the listing price at $130,000, or maybe we'll start it at $140,000, but we'll agree to an offer of $130,000, okay? So let's say that. So if I were to sell this property for $130,000, and then including the money that I paid to the borrower for the deed in lieu and have them move out, as well as realtor commissions, right? Closing costs. Let's say we're about $15,000 in for closing and sale costs, okay? And we paid $29,500. Well, the profit here is $85,500, okay? So that's pretty awesome. So if the borrower were to stop paying on this note, that's my first step is I'm going to take, is I'm going to really try and see if I can get them to do a deed in lieu, okay? But the other thing to think about, and one of the reasons I was really keen on buying this note, is because I'm pretty confident that this borrower is going to keep paying if they can, right? Because they don't owe very much on their mortgage. Remember, they owe like $37,000. And if they look, they're going to know that they own a property that's worth around $140,000, right? So they're going to try and stay in their home. They don't want to lose their home to foreclosure and lose all that equity, right? They're going to either sell the property, or they're going to figure out a way to keep making their mortgage payments. They're going to do something so that I don't foreclose on them, and then they lose all that $100,000 in equity, right? So based on this, chances are this is going to be a pretty good borrower, and the cash flow option is what we're going to get, okay? Okay, so what if the borrower, because people don't always stay in their homes, right? People get new jobs, people get, like I said, divorced, they want to move up, buy a different house, whatever it might be, downsize, their kids move out. So what happens if the borrower just decides to sell this next week, next month, next year, okay? Well, as I mentioned before, I'm only owed the principal balance. When I bought this note, I'm only owed what is owed on the balance, okay? So in that case, the borrower would sell the house, or maybe they'll refinance with a new bank at a lower rate, because right now they're paying 10%. So maybe rates go down eventually and they get like a 7% loan. So either way, whether they refinance or sell, I'm going to recoup the full principal balance that they owe on the loan. And because we bought the loan from the seller, the note seller, at a discount, not a huge discount, but a discount, I'm going to profit if they were to pay us off $6,800. Okay. So I've got all of the options pretty much covered here, right? Number one, they keep paying. I've got a nice 15% return on my money, right? I've got monthly cash flow coming in every month, right? Number two, they stop paying and we have to foreclose, or we do a deed in lieu, cash for keys, and then we sell it off and there's profit there. Number three, the borrower refinances with a better interest rate, a new lender, or they sell the property and there's a little bit of a spread there. So I get some extra profit as well. So all in all, I really like this deal. It's a little deal. $29,500. That's a small purchase, but it's a nice little deal, and I'm pretty happy that we got it. All right, I'm going to go through this next one. I know I've been rambling on quite a bit here. So I'm going to go through this one now a lot faster because I think I explained a lot of the details of how this works in the first one. Okay, so I'm going to fly through this second example a little bit quicker. Okay, so this one here, very similar. It's a performing note again. And this is one I'm actually in negotiations with the same seller that sold me the one in Detroit. Okay, so they were selling about 20 loans. And so this one, I have not closed on it yet. I've got a bid accepted, and I'm actually looking for a funding partner on this one. So if you're interested in doing a deal like this, please reach out and we can maybe make something work here. Okay, but this one's in Toledo, Ohio. And you can see here, I don't know if you can see from the photo, but it's actually a duplex. There's 2 units here, side-by-side duplex. All right, so let's look at the numbers on this one. They're actually pretty similar. It's not quite as good a deal because the property's not worth as much as the first example, but the cash flow and everything works pretty good. So I'm not going to put the full address here because I haven't bought the note yet, and I don't want to violate any disclosure things with the seller. Okay, so I did sign an NDA. So let's just say it's Toledo, Ohio. And I did get a broker price opinion on this property, as well as I do with every note. I get a bid accepted on as part of my due diligence. And it came in, the value of the property came in at $60,000 as is. Okay, so a lot lower than the other one. $60,000. The amount the borrower owes is very similar to the last one, $37,000 again. Okay, and I was able to negotiate a purchase price to buy the note, not the property, for $23,000. Okay, so you can see these numbers are really similar to the last deal. The property value is the only difference. The borrower is currently paying 11%, and she actually has 2 different notes with the same note seller, and she's actually renting both units of this duplex out. So she's not living in the property. She's actually the landlord, and she's got tenants in. Okay, so monthly she's paying $372 on this loan. And it's a 20-year amortized loan. So not a 30 like the last one. It's a 20-year mortgage. She acquired this property and the mortgage in July of 2022. So she's had it a year and a half. And so she's got until 2042 to fully pay off this loan. And she is performing. She has not missed a payment as well, which is great. So what do the cash flow numbers look like? So again, purchase price $23,000, the monthly payment $372. So in 12 months, I would make $4,464 in income. All right. You divide that by the investment, which is $23,000, and it's a 19% return. So it's actually got a higher yield than the other deal, which is great. 19%. It's hard to find that kind of deal. And then I'll break it down. So if we were to foreclose, which again, she's not missed a payment, so you don't expect that she will, but you never know. One thing to think about with landlord borrowers is if someone gets into financial trouble, they're going to choose between either paying their rental property mortgage or their own residence. They're probably going to want to stay in their own home and sacrifice the rental property, right? So that is a little bit of a risk, I guess, is that if you have a landlord borrower, if things start going bad for them, they're going to abandon the rental property mortgage first. Okay, that's okay. Like I said, she's had great performance so far. Okay, so if she were to stop paying, let's say that now we went to foreclose on this property, foreclose on the borrower, hire a local real estate attorney to handle the foreclosure. Okay. And I'm going to assume that the bidding, it gets sold for $45,000 at the foreclosure auction. Okay, because again, the buyer wants a discount, so they're probably not going to pay full price at a foreclosure sale. They might, but let's assume they don't. Okay, well, in this case, again, the borrower owes $37,000, so this is going to sell above the principal balance probably, which means that I don't get that spread. I just get the difference between $37,000 and $23,000. And then if I have to pay a foreclosure attorney to foreclose, I'm going to put in $5,000 in there in attorney fees. Although depending on how the note's written, you might be able to recoup those attorney fees. It just depends on how the terms of the note are written. And I can't remember on this one. So I may be able to recoup that $5,000 when we foreclose. But assuming not, the profit on this one is $9,000. Okay. Now let's say that no one bids. We start the bidding at $37,000 because that's the amount that's owing on the mortgage. Well, let's say that no one bids on it because they, for whatever reason, they think that's too high. Well, then now I would own this duplex, and if I've paid 23 for it, I could sell it for 60 or 45, something like that, right? I could hire a realtor and then just sell it off. Okay, or I could keep it, and now I got a duplex, keep the tenants in there, and now I've got a nice duplex in Toledo, right? Okay, and then the deed in lieu or cash for keys scenario. So again, I could give that borrower, say, look, your rental properties, you're not making your payments. I'll give you $5,000 if you just deed this property back to me, right? So we would do a deed in lieu. She would deed the property over and she'd wipe her hands clean of this rental property. And then I would hire a realtor and say, Mr. and Mrs. Realtor, let's sell this thing off. And let's say that I agree to an offer of $55,000. Okay. I got about $10,000 in closing costs, sales costs, realtor commissions, the amount that I paid for the deed in lieu, the cash for keys that I paid to the borrower, $10,000. And so I've put in $23,000 into it to buy the note in the first place. So if you subtract $55,000 minus the sale costs, minus recouping the original investment, there's still $22,000 in profit. Okay. So that's still good. That's awesome. I got a 19% return when she's paying. If she were to ever stop paying, could do a deed in lieu, hopefully, and get $22,000. So that's pretty great. Okay, and then the final option is maybe she decides to sell, or maybe she wants to refinance. She finds a better lender that'll give her a cheaper mortgage at a lower rate than 11% on her rental. Maybe they'll do her whole portfolio or something. So they decide to pay us out. Well, again, I paid 23. She owes 37 right now. So I'd be making 14,000 in profit. Okay. And obviously over time, she's going to pay down that balance. So the numbers will change. But these are how I look at my note acquisitions before I make a bid, or before I at least close on the purchase of the note. Is I look at these scenarios, I run my numbers, and I think, okay, if this happens, what does it look like? If this happens, what do the numbers look like? And my goal is to make sure that any of these scenarios, I'm not going to lose the initial investment, or my private lender, whoever my funding partner is. I don't ever want to lose their money. So I want to make sure that these scenarios all make sense, so that if we had to take one of these options, we're still going to be able to recoup our initial investment, but also hopefully get some profit at the same time. All right, that was a lot. Stop sharing. Okay, so I hope you guys got something out of that. If you have any questions, like I said, actually, let me just go back here and share my contact information. All right, so if you have any questions, I'll work on see if I can get the chat going. But if you have any questions, I hope you wrote them down. Feel free to send me an email at cal@calewing.com. Or we could even schedule a call if you're really getting into note investing and you like these kinds of deals. As I said, that Toledo deal, I'm still looking for a funding partner. And I'm seeing these kind of deals all the time, guys. So I'm always looking to work with other people that want to do deals, but maybe don't have the time or the expertise, don't know where to find these kind of deals themselves. I'm looking for funding partners. I'd be happy to talk about what that might look like, see if there's a fit between us. And maybe we can do a note deal together. And so if you want to talk, you can go to talkwithcalewing.com, and that'll take you to my calendar page. You can schedule a time and we can talk notes, we can talk real estate. I can explain and answer any questions you might have about what this looks like, and just note investing in general. If you're confused by anything I said, you want to know more about how this works, feel free to book a call. Also check out my website, calewing.com. And I've got lots of videos about note investing. So if you go to my YouTube page at Cal Ewing _real estate. You can check out lots more content as well on note investing. I try to post every week new videos about real estate investing and note investing. All right, so thanks everybody for joining. I'm glad you're here, or if you're watching the replay, hope you enjoyed it. Like I said, I'm trying to do these at least one a month. So I'm going to bring some more deals to the table. I'm happy to have you guys come on the webinar again, and we'll look at some different deals at that time. Otherwise, have a great rest of your day. Thanks for joining me, and looking forward to connecting with you. Have a good one.